Before we start, let me be clear. This is not financial advice. This is education to help you think, plan, and act like an advanced investor. You've already learned the beginner rules: start early, stay invested, keep costs low, diversify, and don't panic when markets fall. You've also gone deeper with the intermediate rules: setting up an asset allocation, rebalancing, thinking about taxes, and creating withdrawal strategies. Now it's time to step into advanced long-term investing. At this stage, success isn't about guessing the next hot stock or timing the market. It's about optimization, discipline, and risk management. It's about building portfolios that don't just grow but survive. Advanced investors focus on details that beginners ignore, things like risk-adjusted returns, tax drag, sequence of returns risk, and global allocation. These are the details that separate the wealthy who stay wealthy from the investors who get wiped out by one bad decision. Today, I'll walk you through the 10 golden rules for advanced long-term investors. Each one will show you not only what to do, but why it works, backed by data and history, and how to apply it to your own strategy. The first rule is to master risk-adjusted returns. Most people only look at the headline number: how much did my portfolio return? Advanced investors ask, how much risk did I take to earn that return? The answer matters more than most realize. Here's why. Imagine two portfolios. Portfolio A and Portfolio B both return 8% a year over 20 years. But Portfolio A has low volatility while Portfolio B is all over the place. The end result? Portfolio A ends up worth significantly more because it avoided the destructive effect of volatility drag. This concept is captured in the Sharpe ratio, created by Nobel Prize winner William Sharpe. It measures how much excess return you earn per unit of risk. The higher the Sharpe ratio, the better your portfolio is performing relative to the risk it's taking. A portfolio with a Sharpe ratio of 1 or higher is considered strong. Now here's the real kicker. Most investors don't realize that two portfolios with identical average returns can leave them with completely different amounts of money after decades. Why? Because volatility compounds against you. A 50% loss requires a 100% gain just to break even. If you can avoid huge drawdowns, you don't need miracle recoveries. Action step: when evaluating investments, don't just look at return. Look at volatility and Sharpe ratios. Favor investments that deliver steadier returns with less risk. In the long run, smoother wins. The second rule is advanced asset allocation. Beginner investors stick to simple splits like 60-40. Intermediate investors tilt toward more stocks if they have longer time horizons. Advanced investors understand that asset allocation is not a fixed number but a dynamic strategy. One approach is risk parity, pioneered by Bridgewater Associates. Instead of allocating by dollar percentage, you allocate by risk contribution. In a traditional portfolio, stocks dominate risk even if they're only 60% of the portfolio. In risk parity, bonds and other assets are weighted so that each contributes equally to volatility. The result is a more balanced ride, especially during crises. Another advanced strategy is customizing glide paths. Target date funds gradually lower stock exposure as retirement nears, but advanced investors adjust these paths. Some keep higher equity exposure longer for growth. Others create bond tents to reduce risk in the 5 years before and after retirement, a period most vulnerable to sequence of returns risk. Action step: stop thinking of allocation as set in stone. Test how your portfolio behaves under different conditions. Adjust allocation dynamically as your needs, markets, and risks evolve. The third rule is to optimize for global tax efficiency. At this level, taxes can eat away more than market volatility. Morningstar found that poor tax management can reduce returns by 1 to 2% a year. Over 30 years, that can mean hundreds of thousands of dollars lost. Advanced investors use asset location. Bonds and REITs produce high taxable income, so they go into tax-advantaged accounts like IRAs or 401(k)s. Broad equity index funds are highly tax efficient and can sit in taxable accounts. International investing introduces another wrinkle. Foreign dividends often face withholding taxes. But with the right ETFs and by filing IRS Form 1116, U.S. investors can reclaim some of those taxes. Another layer is cross-border planning. For investors who live abroad or hold international assets, tax treaties can reduce double taxation. Wealth managers spend enormous effort on this, but individuals can apply the same principles. Action step: audit your portfolio not just for allocation but for tax placement. Every asset should live in the account where it is most tax efficient. Saving 1% a year in taxes is the same as adding 1% in returns, and both compound massively. The fourth rule is withdrawal optimization. The famous 4% rule, first introduced by Bill Bengen in 1994, was based on U.S. market history. It suggested that withdrawing 4% a year from a balanced portfolio would likely last 30 years. The Trinity Study in 1998 reinforced this. But times have changed. With today's lower bond yields and higher volatility, Morningstar's 2022 update suggests a safer withdrawal rate closer to 3 to 3.5%. Advanced investors don't follow one fixed rule, they adapt. Guardrail strategies like Guyton Klinger adjust withdrawals up or down depending on market performance. If markets do well, you can take more. If markets crash, you temporarily cut back. Wade Pfau and other retirement researchers have shown that flexible withdrawals significantly improve portfolio survival. Action step: build a flexible withdrawal strategy, not a rigid one. Use cash buffers, guardrails, or dynamic rules. Protect yourself from running out of money by planning for both good years and bad years. The fifth rule is to use alternatives wisely. Alternatives are assets outside of traditional stocks and bonds, REITs, commodities, gold, hedge funds, private equity, even crypto. They can diversify your portfolio, but they come with trade-offs. Take REITs. Since the 1970s, REITs have returned around 9% annually, offering real estate exposure without direct property ownership. Commodities, on the other hand, are great inflation hedges but have weak long-term returns. Gold barely beats inflation but shines in crises, spiking when markets panic. What about hedge funds and private equity? The Yale endowment model became famous for allocating heavily to alternatives. But here's the truth: Yale had access to elite managers and unique deals. Most hedge funds underperform after fees. Private equity requires long lockups and high minimums, making it inaccessible for most. Action step: if you use alternatives, cap them at 5 to 10%. Think of them as insurance or seasoning, not the main course. The backbone of your wealth should still be broad, diversified stock and bond exposure. The sixth rule is behavioral mastery. At the advanced stage, your greatest enemy isn't the market, it's you. Nobel laureates Daniel Kahneman and Amos Tversky showed that losses feel twice as painful as gains, a bias called loss aversion. Recency bias makes you think the last decade will repeat. Overconfidence makes you believe you're smarter than the market. Dalbar's famous QIB study proves the cost. Over 30 years, the average equity fund investor underperformed the S&P 500 by 3 to 4% annually. Not because funds were bad, but because investors bought high and sold low. That behavior gap costs real wealth. Advanced investors fight this by creating systems. They write an investment policy statement to guide decisions. They set rebalancing rules in advance. They automate contributions so they can't sabotage themselves. Action step: master yourself. Acknowledge your biases. Build guardrails. Discipline beats brilliance in the long run. The seventh rule is to manage sequence of returns risk. Here's a scenario. Two retirees have the same portfolio and the same average returns. One retires in 1995 and rides the late 90s bull market. The other retires in 2000, right into the dot-com crash. The first thrives, the second struggles. This is sequence of returns risk. If bad markets hit early in retirement, withdrawals amplify the damage. Even if the long-term average is fine, you can run out of money. History shows that retirees in the 1970s stagflation era faced far greater challenges than those who retired in the booming 1980s. How do advanced investors prepare? They hold 1 to 2 years of expenses in cash or short-term bonds. That buffer means they don't have to sell stocks at a loss in downturns. Some use dynamic withdrawals. Others use partial annuities to lock in guaranteed income. Action step: plan not just for average returns, but for the order of returns. Sequence matters. Protect your early retirement years with buffers and flexibility. The eighth rule is hedging and downside protection. Hedging can save you, but it's costly. Protective puts, inverse ETFs, and tail risk funds can limit losses during crashes. But if you buy them constantly, you bleed away 1 to 2% of returns annually. Over decades, that destroys compounding. That said, in certain moments, like 2008 or March 2020, hedges saved portfolios from catastrophic drawdowns. Advanced investors don't hedge constantly. They hedge tactically, when valuations are stretched or risks are asymmetric. Action step: Understand hedging tools. Use them sparingly as protection, not as a permanent feature. Staying invested is what builds wealth, but selective protection can keep you in the game during extreme events. The ninth rule is macro and currency awareness. Global diversification is valuable, but advanced investors know it comes with currency risk. If you're a US investor in European stocks, your returns depend not just on company performance but also on the euro versus the dollar. A rising dollar can cut your gains. A falling dollar can boost them. Macro cycles also matter. In the 1980s, a strong US dollar hurt emerging markets. In the 2000s, China's growth fueled a commodity supercycle. Today, central bank interest rate policies and inflation regimes shape returns across asset classes. Action step: pay attention to currencies and global cycles. You don't need to predict perfectly, but awareness helps you understand portfolio behavior. Consider hedged ETFs if currency volatility is a concern. The 10th rule is legacy and wealth transfer. Advanced investing is not just about you. It's about what happens after you. Studies show 70% of family wealth is lost by the second generation, and 90% by the third. Not because of bad markets, but because of poor planning and lack of financial education. Estate planning tools like charitable trusts, donor-advised funds, and tax-efficient gifting strategies can preserve wealth. But the other half of the equation is teaching. Passing down money without passing down wisdom is a recipe for failure. Action step: build a legacy plan. Protect your wealth with estate tools, but also teach the next generation how to manage it. Long-term investing doesn't end when you do, it continues through your family. Let's wrap this up. These are the 10 golden rules for advanced long-term investors. Master risk-adjusted returns. Build advanced allocation strategies. Optimize for global taxes. Withdraw flexibly. Use alternatives wisely. Master your behavior. Manage sequence of returns risk. Hedge selectively. Stay aware of macro and currency trends. And plan for legacy and wealth transfer. At the advanced stage, success isn't about hitting home runs. It's about consistency, resilience, and preparation. Advanced investors don't just plant orchards. They build forests that can withstand storms and feed generations. And one last reminder, this is not financial advice. This is education to guide your journey.